Start your day with It's the Business. Here's Phil Dobbie.
Well, the Bank of England meets today. Remember when we used to hang out to see if interest rates would rise? We'd hang on their every words. Well, we're going to have a long wait for that to happen. Last night, the US central bank, the Fed, signalled that interest rates wouldn't rise until the end of 2023 at the earliest, and probably not until 2024. But why do we care what's happening on the other side of the Atlantic?
The Federal Reserve, the US central bank, is the conductor of the global economic orchestra. It is the most powerful economic institution in the world. Markets care what the central bank in the US says. So this indeed was a big day.
Kallum Pickering from Berengers Bank reckons rates might actually rise a bit sooner than the Fed is indicating. But what about here? What will the Bank of England say and do today? We'll get Callum's take on that later in today's podcast. Plus, democracy. Is it being challenged by government consultants, one in particular who wants to pursue their own agenda?
Secondly, double the science budget. Third, create some ARPA-like entity. And fourth, support me in trying to change how Whitehall works and the Cabinet Office work, because it's a disaster zone.
The deal that saw Dominic Cummings move into number 10 as our de facto MP, is he the reason we've decided to up our nuclear capability? And Uber, its share price fell 5% yesterday. Could that be because its business model has been ripped apart in this part of the world? It's Thursday, the 18th of March, 2021. Good morning.
And now, it's the business, making sense of it all, with Phil Dobbie.
Now, do you remember how we voted for Boris Johnson? You know that process where you go and tick a name on a box, and whoever gets the most ticks becomes the Prime Minister. Do you remember that process called democracy? Well, we probably expected that person who we appointed would be the one making the decisions, along with other elected representatives in the Houses of Parliament, about how we want the country to be run. But now it seems so desperate was he to get outside advice on Brexit that he would let Dominic Cummings set the agenda, an unelected person who we paid. And because we were paying him, you would have thought he would be acting on the will of the people. But I don't remember asking for all of this. Do you?
Essentially what happened in terms of what you're talking about is the Prime Minister came to speak to me the Sunday before he became Prime Minister and said, would I come into Downing Street to try and help sort out the huge Brexit nightmare? I said, yes, if, first of all, you're deadly serious about actually getting Brexit done and avoiding a second referendum. Secondly, double the science budget. Third, create some ARPA-like entity. And fourth, support me in trying to change how Whitehall works and the Cabinet Office work, because it's a disaster zone. And he said, deal.
Where did he say deal? Where were you when that was concluded?
In my living room Sunday before he became Prime Minister.
Just you and him, or were there others there?
Just him, just me and him.
All very cosy, isn't it? Dominic Cummings at the UK Science and Tech Select Committee yesterday. So some of the things he was talking about that he wanted, and he had the sort of Prime Minister over a barrel, really, because obviously the Prime Minister didn't know what to do about Brexit, how to motor forward with what he'd promised. So there we are. Dominic Cummings asked for doubling the science budget, reforming Whitehall, creating something like ARPA, which is the defence programme that Eisenhower introduced years ago in response to the Soviets when they launched the first Sputnik satellite. He wanted to use money and tech to try and beat the Soviets. He wanted to do something like that. Well, coincidentally, here's the Prime Minister last year when Dominic Cummings was still working at number 10, announcing that big increase that Dominic Cummings had wanted in defence spending, £16.5 billion over 4 years of extra money.
My choice, and I hope it will carry every member of the House, is that Britain must be true to our history, to stand alongside our allies, sharing the burden and bringing our expertise to bear on the world's toughest problems. To achieve this, we need to upgrade our capabilities across the board.
And then this week we heard, of course, the review of defence means, amongst other things, lifting the limit on our Trident nuclear warheads from 180 to 260. And we're going to get more on this with the Defence Command paper, which will be published on the 22nd of March. But the thing is, none of this was talked about before the election. In fact, we had that 6-point plan from the Tory party manifesto before the election, didn't even mention any of this. In fact, extra funding for the NHS was one of the 6 points, 20,000 more police, tougher sentencing for criminals, an Australian-style points-based system, millions more to be invested in science, schools, apprenticeships and infrastructure while controlling debt. How's that one working out? Reaching net zero by 2050 with investment in clean carbon solutions and not raising the rate of income tax, VAT or national insurance. Nothing there about increasing defence spending or increasing our nuclear capability. And yet, that was one of the things that had been asked for by Dominic Cummings as a condition for taking a job, to push the agenda forward that nobody had voted for. That seems to be how the country is run these days. Democracy is a nice idea, but not necessarily working in practice. Something else that's not working in practice, Uber. I wonder whether the model for Uber is broken, because as of yesterday, following that court ruling, more than 70,000 workers will be treated as workers under UK employment law. The workers will be workers. The drivers will be workers, which means that they'll be entitled to a minimum wage and holiday pay and pension contributions. Uber have been trying to put a positive spin on this, saying it's a good thing for them too. It's hard to see why. And they're saying it's not going to push up the price of getting an Uber, which would be hard to prove, wouldn't it? Because the whole idea, the whole business model of Uber was that it reacts to demand and supply. So if you're trying to get an Uber and there is great demand and very few Uber drivers, then you're going to pay more for it. And conversely, if there's loads of Uber drivers logged in, but there's only a few people who want a cab at that time, then you pay less for it. It's going to be pretty hard to prove that prices have gone up one way or the other, given that it is a moving feast. But this is Jim Cramer. He's a markets commentator on CNBC at the market open in the US yesterday, basically saying that Uber drivers are just too costly.
That's a bad model. You want to get rid of them and you want autonomous cars. But, Carl, this is not something that would make me want to buy at least Uber. Not at all. They can't. Right. They do well because they don't pay this stuff.
Right, the driver's expensive.
That's it in a nutshell, isn't it? They're doing well because they're not paying the staff. They're not paying it for all the stuff, all the minimum wage and holiday pay and pension contributions and all that sort of stuff. Jim Cramer there, neatly summarising it, I think, because the business model is based on paying people below the minimum wage or whatever the lowest they can get away with. And that means it's an unsustainable business model, surely. If the whole competitive advantage is we pay our staff less, so we're going to undercut other people, you lose that edge when the court comes along and says, well, no, you have to pay the same as everybody else. And you wonder about the contagion of this. Does this mean Uber Eats is going to have to follow the same course? And what does this mean for the IPO for Deliveroo here in the UK, if this is the beginning of a transformation for the gig economy? And I wonder whether it's actually going to get worse for Uber as well. Not just because of that contagion for the same rules applying for Uber Eats, but also the definition of minimum wage that they are paying at the moment. What is that based on? It seems like it's only based on the time spent driving. Now, if you ran a clothes store, for example, and the clothes store was quiet for a couple of hours each day, you would still be paying people to stand in that clothes store, even though there was nobody in it. So it's not a like-for-like comparison. The Uber equivalent would be, well, you're not serving anybody. You're not providing any useful advantage to our company. So we're not going to pay you while the clothes store is empty and you're not selling. So similarly, they're saying to Uber drivers, you only get the minimum wage for the hours that you're there, that when you are logged on. And if there's nobody there, then we don't pay you. And you can see Uber's point of view in that, because what is to stop you? In that clothes store, you're not going to nip out when the store is quiet and go and work for someone else. Whereas if you are a cab driver logged onto Uber and another hailing app, another cab hailing app that does have a customer, then you could go and work for them for a trip. It doesn't make sense that Uber is going to pay you for being logged onto their app if they're not providing any business, if you are getting some money from somebody else. So it's a complicated model, but it's also an unsustainable business model, isn't it, really? And if their costs are going to go up, it's going to become even more unsustainable. On the one side, you've got people there working for them really out of desperation because no money is not an option. Some money is better than no money, even if it's not a full wage. And of course, because it's not a full wage for most people, then they're going to be claiming some sort of benefit to make up the rest, which means you, me, everybody who's a taxpayer, we are really subsidizing Uber for not paying a wage that people can live off. It is the same for every company that pays people very little. The rest of us are making it up in benefits, so we are, in effect, subsidizing that company. And that company isn't paying anything back. I mean, it's not paying any tax because it's not making a profit. it has to pay VAT. But even that, it had found a loophole, which meant it wasn't paying that for a long time. But I understand they've now got a massive backdated VAT bill, which they've got to pay. You can't avoid VAT. But the rest of it is pretty complicated, isn't it? As to what you define as the hours worked and how much you pay people. So we'll see. I think the whole thing is far from resolved. And it is an unsustainable business model. I mean, if it wasn't before, it certainly is now. But I mean, just look at last year, Q4 2020. Gross bookings of $17.2 billion, EBITDA minus $454 million. So in effect, in a quarter, they are losing almost $500 million per quarter. This is a company that has never made a profit, not even close, and now their costs are going up. No wonder then that their share price yesterday fell by about 5% as this news broke that they were now enforcing the regulations that the court had told them to. It looks like it's just downhill, doesn't it, for Uber, I would have thought?
It's the business, making sense of it all.
With Phil Dobbie.
Tell you another unsustainable business model, Uber Flights. They never tried that, did they? Would you be flown somewhere by whichever pilot is willing to do it for the least money at a time that suits them? I don't think that would work. But how much of the rest of the airline industry is sustainable, even without Uber flights? We might be happy to fly to Spain when we're allowed to, but what about long-haul flights? And how have airlines managed to make it through without passengers? Well, airline industry commentator John Strickland is going to join me tomorrow morning to talk about all of that. But first of all, today, to the meeting of the FOMC, the Federal Open Market Committee, which is the board at the US Central Bank, the Federal Reserve, who vote on interest rates and these days the amount of QE or bond purchases that the central bank makes. This is a powerful body of people. They really are driving a lot of influence. So why is all of this interesting? Well, lately there's been more interest because bond yields have been rising and there are question marks around inflation. Does this signal that there is an inflation expectation? And all of that is important because it will determine how quickly we'll see interest rates rise, which will impact all of us. Now, Kallum Pickering is a senior economist at Berengers Bank in London. We welcome him back to It's the Business. So, Kallum, if you look at the yields on 10-year treasuries, government bonds in the United States, they have gone from around 0.9% at the start of the year up to around 1.65% now. This is a significant rise. So does this mean that there are investors who are worried that inflation is around the corner? It seems like the market is very divided on this, doesn't it?
Well, you could say that on the one hand, some investors are worried that inflation is around the corner. Those would be the investors that are holding the bonds that would suffer losses when inflation rises above the interest rates that they're earning on those bonds. But on the other hand, you have the other side of the market, which actually takes the higher inflation expectations as something positive, because what it looks like is, at least very tentatively, the world is returning towards a more normal situation. So not the new normal after the financial crisis, but the pre-financial crisis normal with better growth and more inflation. So the other part of the market actually is looking forward to the good growth to come.
But the Fed said at this meeting last night that they are going to keep rates where they are and not even talk about easing off on their bond buying program. They expect rates are going to continue until the end of 2023 into 2024. And any inflation that we do see is going to be very transitory. Now, they've been saying this for a while, and yet there was quite a swift market reaction, wasn't there? I mean, we saw we saw equities reverse direction. We saw the US dollar reverse direction. It actually didn't touch bonds very much, but all the other asset classes turned about face, basically.
Well, nothing soothes markets quite like a central bank is saying that the world is going to improve, but we're not going to raise interest rates. This is the sweet spot. Bring interest rates down and talk up economic growth. But, you really touch on an important point. The Federal Reserve, the US central bank, is the conductor of the global economic orchestra. It is the most powerful economic institution in the world. Markets care what the central bank in the US says. So this indeed was a big day. I have to admit, I don't think that the dovishness, this is what you call it when central banks are telling you that they're not going to hike interest rates, will last as long as the Fed currently anticipates. I think by 2023, perhaps even earlier, there'll be some serious talk of interest rate hikes, because it does look very much like there is some modest inflation to come.
Yeah. Well, but they're saying that inflation will come and then it will go again, and they'll allow the economy to run hot for a while till they get full employment. It's the distribution of employment that they're concerned about, isn't it? But, they want to make sure that everyone's got a job who can work, and that includes those people, lower income workers, who might have been suffering the most. But it's a bit of a blunt instrument for the Fed to be doing that sort of work. Isn't that the sort of work the government should be doing?
Well, you have both policy tools operating in a way that will essentially drive demand and drive the economy as hot as it could be. That's on the fiscal side. You have a big fiscal stimulus. We had the announcement this week, 1.9 trillion. Then you have the aggressive monetary stimulus by the Federal Reserve. And what we should keep in mind here is, policymakers in the US are trying to essentially conduct an experiment. They're testing the limits of US economic growth potential. Remember, the backdrop here is a decade of very disappointing economic growth across the Western world, which led to considerable political disenfranchisement. And what we now have is a chance actually to return to something with a world with better economic growth, a little more inflation, yes, but with a bit of luck, a world where that growth is distributed a little bit better and we don't suffer this political disenfranchisement. So this experiment is essentially to say, let's really drive growth as fast as we can. When we see the inflation, then policymakers will stop. But they're confident actually that they can run this experiment for a while, because in that last decade that we just mentioned, you had sustained economic growth at very low inflation. And on a consistent basis, actually, the labor market data in the US, employment, participation, people re-entering the labor force, consistently beat to the upside. We were consistently surprised by how much supply was left in the US labor market. So the US is really treating the economy like a balloon. They're going to blow it up as much as possible. And when they think it's reached its limit, then they will exit. And hopefully the economy can then float on its own.
Right. But when we were seeing that period where we weren't seeing inflation pick up, I mean, we didn't have a central bank that was buying up $120 billion worth of assets every month. And that's what we've got right now. So what happens if that's actually the influencing factor? And inflation, we let the genie out of the bottle and we can't put the cork back in. What if it runs out of control?
Well, I would just note that the last time we had a serious inflation problem in the Western world, which was in the 1970s, it came on the back of many, many years of ultra-low unemployment and highly aggressive monetary and fiscal stimulus. It's unlikely that we would get to a significant inflationary environment within, say, 2 or 3 years. And indeed, if we started to see some real upside risks to inflation, because interest rates are so low, because governments are running such large deficits, actually it would be easy to control that inflation with some interest rate hikes or even some tax hikes.
Right. But so you're saying that you think that the interest rate rises might happen sooner than they're saying, in late 23 to 24. And yet, obviously, they're not going to raise interest rates while they're still buying up bonds. And yet they're saying they're not even thinking of talking about tapering, in other words, reducing the amount of bond buying they're doing. But you can see that their schedule is going to be faster than they're letting on at the moment, basically.
It would probably come a little sooner than that. And keep in mind, central banks, they have a tool called forward guidance. And basically that is not actions, but words. With their words, they try to fine-tune expectations. And the way to think about the central bank's approach to creating inflation is when markets believe that central banks will reach their 2% targets and keep inflation at that rate, actually central banks make it hard to actually get inflation to that level, because every time it gets close, markets start to believe that interest rates will rise. You see interest rates rise in government bond markets, and then that takes the heat out of the economy. So what central banks are now doing, actually across the world, is playing a little bit fast and loose with this idea that they'll still target 2% inflation. They're convincing markets that they'll allow inflation to overshoot, and it's building up that expectation that central banks will actually behave a little badly. They'll allow inflation to overshoot. That will actually get us there.
And the fact that they're talking that way means that they probably won't have to. It's a bit like when my wife asks me to take the bins out, and of course I say, of course I will, but I never do. Well, sort of like that. We're in a good. Aren't we in a good spot though? Next year, I mean, if we look at where the United States and the UK as well, I suspect. Aren't we in the position where you talk about a Goldilocks economy? That we haven't got that booming inflation. We've got the growth in jobs. Jobs are coming back. We've got GDP sitting, growing, but not too sharp. Everything's just right. I mean, is the US economy heading into that Goldilocks land?
I think actually it will be a bit better than Goldilocks over the next couple of years. We will see rates of economic growth in the US and the UK that we have not seen since the 1980s booms. But keep in mind, this is coming on the back of a historic economic shock. So part of that is catch-up potential. The way I prefer to think about this is the late 90s, the early 2000s, when we had a lot of moderate at a reasonably high level economic growth, with, again, moderate inflation, a little above the 2% targets, with decent productivity growth. I think that's where we're getting back to. And the two reasons to be really optimistic are, first, there's significantly renewed confidence in what policymakers can achieve. Governments have borrowed aggressively and markets have not panicked. They've actually rewarded the economies that have borrowed most aggressively to stimulate a recovery. And despite the fact that interest rates were low at the beginning of the crisis in March 2020, central banks actually found out that markets will still accept those pieces of paper with the Queen's face on or dead president's face on as if they had value. So they intercepted a financial crisis. So we did an experiment and actually it paid off. So now we're confident that policymakers can help us in the future. The other thing, the second factor, is simply that household balance sheets across the Western world have actually improved by and large because of this excess savings argument. Our incomes have been okay actually for the last year, but we haven't been able to spend. So we've run up considerable excess savings.
Yeah, $1 trillion extra, they're saying, in the United States. It's quite a sum of money, isn't it? And then, of course, all the money that's being splashed about by the government. I tell you, Milton Friedman would be turning in his grave if he saw what was happening right now. But maybe, just maybe, Milton Friedman has been proven wrong. Maybe we can throw away those textbooks that we were all reading during our economic studies. Now, look, we get the Bank of England today. So is the Bank of England going to just follow the what's been said by the Fed? Are they just going to take the same script, just change the wording a little bit?
Well, actually, I think the Bank of England will probably shift its risk assessment upwards, so it will sound much more positive about the economic outlook. That's partly a near-term story because the UK is doing so well with the vaccinations, and that's probably going to have the opposite effect, actually, to what we saw with the Fed. Interest rates at the long end of the gilt curve, so the 10-year rate, may actually edge up a little. It's a little too low in the UK. It should be a bit closer to the US level. But, what we should keep in mind here is that interest rates rising are usually a sign that economic conditions are improving. Low interest rates are usually a sign that monetary conditions are tight and economic conditions are being poor. So we should actually welcome this rise in interest rates as long as it doesn't happen too fast or to too much of an extent, as a sign actually that the economic conditions around the world are getting better. We shouldn't then reason from the higher interest rates that things are going to be bad. Central banks will keep an eye on that. As long as these interest rate rises in markets are not excessive, actually, we should just take our cues from that the world is indeed improving.
Yeah, and part of the reason they've got to keep them under control, of course, is because we have all borrowed so much for our houses and enjoyed the fact that we've got low interest rates. So they can't afford to let them increase because, the housing market could collapse like a deck of cards.
Well, the one point I would say there is interest rates will only be able to rise on a sustained basis if wages improve, because it's wages which keep inflation high in the long run. And if wages are higher, then it's easier for us to afford our mortgages. So there's almost a self-corrective mechanism that higher interest rates usually mean higher wages. So the housing market implications are not obvious, in my opinion.
All right. Well, good. Yeah. Well, thank you for that. Kallum Pickering from Berengers Bank. I like that thought that the extra cost of your mortgage if interest rates rise are going to be covered, because the Bank of England won't let rates rise unless the higher cost of your mortgage is going to be covered by the rise in wages, which is brought about by inflation. So that sort of makes sense. So hopefully we won't go back to the late 80s when interest rates got up to almost 15%, do you remember? And 30-year mortgages were more than half the average gross income. But to take his point, it's not quite as bad as that now, but it's getting there, isn't it? Even though inflation is way, way lower because, of course, house prices were so much cheaper then. Now they're higher, but compensated for by the fact that interest rates are so much lower. Although, you do have to wonder, if you look at the rise in house prices, you have to wonder how long that can go on for. Because from back in 1989... when we were paying those extraordinary interest rates, the average house cost £57,000 in the UK, which is the equivalent of £145,000 in today's money, whereas the average house price now is actually £228,000. So house prices since then have grown at 1.5 times the rate of inflation. How long can that go on for? Now, part of it is because we have an expectation that we are going to live in bigger houses, but then you see these new houses that are going up with their tiny rooms. I'm not sure many people, they may have that expectation. I'm not sure. I don't know the numbers, actually, it would be interesting, wouldn't it, as to the square footage of houses then and now. But so I think we do perhaps need interest rates to control that continual upward rise. Maybe it wouldn't be a bad thing if people found that it was a little bit harder to pay their mortgage. Although maybe it's also just a supply factor. I mean, there's only so much land and many more people. We had 57 million people in the UK back then in 1989, whereas we've had another 10 million thrown on that since then. That's about an 18% increase. So if the population growth stagnates because of Brexit, does the rise in house prices stagnate? Of course it doesn't. House prices seem to continue to rise in perpetuity. Of course it doesn't. House prices continue to rise in perpetuity. But maybe that is... of course it doesn't. House prices continue to rise in perpetuity. But, maybe that won't always be the case. We'll have to wait and see. But, by the way, we are talking personal finance with Jasmine Birtles on Monday. We'll talk about what to do with the tax year end approaching. And also, what's all the fuss about non-fungible tokens? The what? So listen in on Monday for more about that. In the newspapers today, this morning, the Daily Star leading with where we started today. The Puppet Master, with a picture of Dominic Cummings controlling Boris Johnson. Boris Johnson is the mannequin with the headline, "I was pulling all the strings." Unelected Dom admits he was real Prime Minister. And the Times and a few of the papers today, the setback for Britain's COVID vaccine rollout, the news that we won't be able to continue at this lightning pace before a dip in supplies for 4 weeks, although AstraZeneca said last night that its supply of the vaccine to Britain was not experiencing any disruption, and there is no impact on their delivery schedule. And they're covering the same supply story in the Telegraph, surprise slump in vaccine supplies. The Guardian, COVID jabs for under 50s delayed a month due to vaccine shortages. And the Daily Express and the Daily Mail are leading with these comments from the EU's Ursula von der Leyen.
If the situation does not change, we will have to reflect on how to make exports to vaccine-producing countries dependent on their level of openness. So we are exporting a lot to countries that are themselves producing vaccines. In our contract with AstraZeneca, there are even 2 sites in the UK that are put in the contract for potential deliveries for the European Union. We're still waiting for doses to come from the UK.
So just maybe they will halt exports from the EU into the UK. That seems to be what she's saying. The pro-Brexit Express saying, proof if you need it, EU will never let it go. The EU is threatening to seize life-saving vaccines heading to Britain. The European argument would, of course, be that AstraZeneca and the UK are not meeting their agreement to provide vaccines to them. And it is still saving lives over there as well, isn't it? But that's the Express for you. Also the headline on the Metro as well, "We'll grab your jabs." And the Independent, this is interesting. Tommy Robinson misused donations from supporters, claim former allies. And the story covers how the founder of the English Defence League declared himself bankrupt earlier this month, despite having received hundreds of thousands of pounds in donations. In fact, £425,000 in donations from his supporters in just 2 months in 2018. And that's on top of the people who paid for his defence when he was jailed for contempt of court. So where did all this money go? Well, implying it's gone on a new car, designer clothes, and Coke. And I don't mean the fizzy stuff. That's what's implied in this argument. But if it's not true, where did the money go? Particularly as his family home, which he says he built himself, was on the market last year for £900,000. So there's quite a bit of money sloshing around. Where has it all gone? And the Daily Mirror, police are set to question Michael Barrymore over the death of Stuart Lubbock in his pool party 20 years ago. After a 50-year-old man was arrested yesterday, the police say they believe someone at the party knows what happened. Well, we know what didn't happen. We know Michael Barrymore didn't jump in to rescue him because he said he couldn't swim, even though he had a swimming pool. Message in those stories, I think, both those stories, don't do drugs, kids. Although, there is a new addiction going around, isn't there? It's called screen time, which is possibly even worse. Look, we look at the airline industry tomorrow morning. That is it for today, though. Have a good day. I'll see you tomorrow morning.
It's the Business with Phil Dobbie. Listen online at itsthebusiness or wherever good podcasts